Good morning, participants. I hope you are all able to hear me and see me. If anyone has video or audio transmission problem, please point out before we start today's session. So apparently there is no problem at your end regarding video transmission or audio transmission, so we'll start our session today. We'll talk about group accounting. We'll try to learn about complex group structures, applying IFRS to different investment types. We'll learn about subsidiaries and consolidation requirements, and perform consolidation under the IFRS 10, which is the guiding standard. In today's economic scenario, the companies are looking for expansion of business and forming global business by acquiring other companies, some of which could be domestic, some could be foreign. Hence they form what is called group. And group consists of holding entity, that is parent, and subsidiary companies in which the holding entity or parent have invested and acquired a controlling interest. So the group accounts aim is to give a true and fair view to the owners of a parent of what their investments represent. So group accounting is one of the complex and biggest topic covered under international accounting standards. But here, for the purpose of our course, topic has been limited to understanding only the overview, underlying conceptual aspects of group accounting. So we cannot go much into details of group accounting, but basically we'll try to understand, have an overview of group accounting and also understand the conceptual aspects of group accounting. There are various standards apply which are related to investments. So the different investment approaches an entity may adopt, and respective IFRS standard will be dealing with that. Like IS 27 deals with requirement of separate financial statements for the parent as well as for parent and the subsidiary companies. Then if the investment in the subsidiaries also, it is covered under IFRS 3 and IFRS 10. Investment in associates covered under IS 28. Investment in joint ventures covered under again IS 28. Joint arrangements under IFRS 11 and financial instruments are covered under IFRS 9 or IS 39. So there are different guidances available for group accounting, particularly relating to investment in by an entity in other entities. Investment by an entity in another entity can be categorized and get accounting treatment accordingly if the investment meets the recognition criteria of subsidiary, associate, joint venture or a financial instrument. So, if the investment by an entity in another entity meets the recognition criteria of subsidiary, then IS 27, IFRS 3 and IFRS 10 will apply. If the investment by an entity in another entity meets the recognition criteria of associates or joint ventures, then IS 28 will apply. And if the investment by an entity in another entity meets the recognition criteria for joint arrangements, then IS 11 will be the applicable guidance. And if the investment in entity by an entity in another entity meets the recognition criteria of financial instruments, which I have already covered earlier, then it is covered under IFRS 9 and IS 39. So basically, investment by an entity in other entities have to be categorized into different types. So based on the categorization, it has to be recognized as either in an associate or in a joint venture or in a subsidiary, and based on that categorization, the applicable guidance will be there. So IS 27 deals with separate financial statements. It prescribes how a parent or investing company should present its investment in individual or separate financial statements apart from preparing consolidated financial statements for the group. So separate financial statement basically means how a parent or the holding company or the investing company should present its investment in individual or separate financial statements apart from preparing a consolidated financial statement for the group as a whole. IFRS 3 defines business combination which comes into existence when control over another entity is established. IFRS 10, it is related to IFRS 3 and defines procedure for a consolidation in group accounting. IS 28 prescribes how investment in associate or joint ventures should be stated using equity method. Associate is where an entity has no control but owns between 20 to 50% of the shares of the investee company. IFRS 11 prescribes when there are joint arrangements which could be joint ventures or joint operations. Of course, joint ventures accounting is prescribed in IS 28 using the equity method. IFRS 9 or IS 39, which we have already discussed in detail, when the investment is having less than 20% equity, it is accounted for using IS 39 or IFRS 9 as financial instruments, which we have covered in details in one of the earlier lessons, if you remember. So which standard does an investment affect? How do you decide which standard does an investment affect? So whether the investment by the investing company creates a control over investee, first thing, this is a decision flow chart. This decision flow chart helps in the investor to identify the right bucket where an investment will fall and how to deal with in respective IFRS provisions. So where the investing company has control over investee. Now here control, we will define separately in subsequent slide what is meant by control. So if the investing company has a control over the investee, answer is yes. If the investment is such that the investing company has a control over the investee company, that means the company in which the investment has been made. And if the answer is yes, then consolidation as per the IFRS 10 has to be made. Disclosure will be made as per the IFRS 12. So the consolidation of financial statements for the purpose of presenting the financial statements of the group, it will be done as per the IFRS 10, and disclosure requirements as per the IFRS 12. If the investing company doesn't have a control over the investee, then we look at the question whether it has a joint control with some other company, whether it is having joint control over the investee company along with another company. If the answer is yes, if there is a joint control over the investee company, then IFRS 11 will be the applicable standard. So again we have to look at two possibilities, whether it's a joint operation or a joint venture. Now joint control can be in the form of joint operation or joint venture. If it is a joint venture, then account for an investment as per the IS 28. The investment will be accounted for in the books of the investing company as per IS 28, and disclosure will be as per IFRS 12. If it is a joint operation, that means whether it's a joint control or joint venture is decided by the factor whether the interest in the net asset of the, is it interest in the net asset of a separate entity. So if the answer is yes, it's a joint venture. If it is no, then it is, answer is no. Answer is no, and it's a joint operation. So if it is a joint operation, then account for assets, liabilities, revenues and expenses, and disclosure will be as per the IFRS 12. If it is not a joint control, but still the investing company doesn't have control over the investee, and it's not a situation of joint control, then whether there is significant influence over the investee, not control, but whether the investing company has significant influence over the investee. If the answer is yes, this will be treated as an investment in associate, and it will be accounted for an investment as per the IAS 28, and disclosure will be as per the IFRS 12. If there is no significant influence, then the treatment will be under IAS 39 or IFRS 9, as investment will be considered as financial instrument, and the accounting treatment will be as per IAS 39 or IFRS 9. So this decision flow chart actually helps us to understand, in the case of investment by an entity in another entity, which standard would apply. So you have to recognize, based on the various criteria given in the decision flow chart, we have to recognize first of all whether the investment is an investment in a subsidiary or an associate or in a joint venture or in a joint operation, and then apply the guidance available under different accounting standards. Definition of control, of course, we will go into more details regarding definition of control. Definition of significant influence also will be covered separately when we discuss IAS 28, associates and joint ventures. That will be in the subsequent session. Basically, to summarize, if investment is such that the investor exercises control over the investee, then the investee is a subsidiary. If the investment is such that the investing company or the investor exercises control over the investee company, then the investee is a subsidiary and the IFRS 3 or IFRS 10 applies. If there is no control, then check if there is joint control with another entity. If yes, then it is either a joint arrangement or a joint venture. If joint control is in the operations of a separate entity, then it is joint venture, which has to be accounted for in IAS 28 using the equity method, which we will discuss subsequently. If there is no joint control but investor has significant influence over the investee entity, such that the investee is an associate and has to be accounted for with equity method in IAS 28. However, if there is no significant influence, then the investment is only a financial instrument, that is a financial asset at fair value through profit and loss for investor. So the decision flow chart tells us basically which standard should an investment affect. Now we come to certain definitions. So if you look at the diagram, there could be a holding company, that entity controls one or more subsidiaries. Control normally means, again, control normally means owning more than 50% of the equity shares or ordinary shares of the investee entity. So if the holding company is an entity that controls one or more subsidiaries, its control is greater than 50% of the shares. The investment in those companies will be treated as subsidiaries. So holding company and subsidiary together forms what is called a group. A holding company or the parent company plus all its subsidiaries, that means companies in which the holding company is controlling more than 50% of the voting shares or ordinary shares. So those are subsidiaries. So holding company together with all its subsidiaries constitute what is called a group. So the group accounting applies to the entire group, that means the holding company plus all its subsidiaries. If a company has significant influence over another company, significant influence normally we mean by owning 20% to 50% of the voting shares of the investee company. Then the investee company is considered an associate. Associate is an entity over which another has significant influence and which is neither a subsidiary nor a joint venture. Then there can be, the investor company can have control over another entity through a joint control mechanism. It could be a joint arrangement or joint venture. So arrangement of which two or more parties have joint control over another company. And if the investment in the investee companies comprises less than 20% equity shares, voting shares of the investee company, then we consider it as the investment is considered as financial instruments where the applicable standards will be IAS 39. So the diagram depicts parent or holding company is an entity which controls one or more entities which are its subsidiaries. Subsidiaries are those entities over which another entity like holding company has more than 50% and it exercises control as defined under IFRS 10. So we'll come to the definition of control subsequently as per IFRS 10. Group consists of holding and all its subsidiaries only. So associates, joint ventures are not part of the group. Please understand. When you talk about group accounting, the investment in associates or investment in joint ventures will not be considered for the purpose of group accounting purpose. So those investments will be treated separately under IAS 28 or some other accounting, IAS 28. So group normally consists of holding company or the parent company and all its subsidiaries only, not others. Associate is where another entity has significant influence, owns between 20 to 50% of the equity shares, and which is neither a subsidiary nor a joint arrangement. So we'll see the definitions in more details in the next slides. Now some of the key concepts we'll come across is separate financial statements. These statements are those in which the investment in subsidiaries, associates and joint ventures are accounted for at the cost or fair value in accordance with the IFRS 9. So these are financial statements in which the investments in subsidiaries, associates and joint ventures are accounted for at cost or at fair value in accordance with IFRS 9. This is the concept of separate financial statements. So when an investee company reflects the investment in subsidiaries, associates and joint ventures either at cost or at fair value in accordance with the IFRS 9, those financial statements are considered as separate financial statements. Consolidated financial statements, the financial statement of a group, that means holding company as well as all the subsidiaries owned by the holding company, are presented as those of a single economic entity. So the group is considered a single economic entity, although it actually comprises of holding company and several subsidiaries. So the financial statements of a group basically means consolidating the financial statements of the holding company as well as the subsidiaries into one single statement. That is called consolidated financial statement. So the financial statements of the group is presented as those of a single economic entity. They consolidate all subsidiaries, both foreign and domestic. All subsidiaries' financial statements will be consolidated along with the holding company's financial statement in a consolidated financial statement for the group. Parent or holding company, it issues the consolidated financial statements. Who issues the consolidated financial statement? The parent. The parent of the holding company will prepare a separate financial statement for itself. Along with that, it also will prepare a consolidated financial statement for the group as a whole. That means it will consolidate with its own financial statement, it will consolidate the financial statements of all the subsidiaries owned by the holding company, irrespective of whether the subsidiary is a foreign or a domestic company. So parent and holding company actually issues the consolidated financial statements in addition to its own separate financial statements. Please understand this concept. So if company A is the holding company which has made investment in B, C and D as subsidiaries, each of the companies A, B, C and D will prepare their own financial statements. And in addition to that, the company A, which is the parent company or the holding company, will prepare a consolidated financial statement where the financial statements of A, B, C and D all will be consolidated into one financial statement which will reflect the financial statements of the group represented as a single economic entity. Although each companies A, B, C and D are separate economic entities, but for the purpose of the group consolidation, we treat the group as a single economic entity, and the separate financial statements prepared by A, the holding company, and B, C and D, the subsidiary companies, will be consolidated into a single financial statement for the group as a whole, taking the group as a single economic entity. That is called consolidated financial statement, and it is issued by not B, C and D, it is issued only by A, the parent company. They will prepare the consolidated financial statements and present it to the users. Next we come to another very important concept which we have been using, the word we have been using quite often, which is called business combination. Business combination is nothing but a transaction or other events in which the acquirer obtains control of one or more businesses. The acquiring company or the acquirer obtains control of one or more businesses. Those transactions or events which results in the acquirer obtaining control of one or more businesses is called a business combination. So when a company A buys another company B or buys more than 50% share of another company B, then that is a business combination. It has happened, it is happening all the times. Even today in the Economic Times, I came across a news today in the morning that Jindal Polyester Limited, the largest polyester film manufacturer in India, they are planning to buy an European company. They are planning to buy an European company which is in the same business. So this will be, if this transaction takes place, this will be called a business combination. When Jindal Polyester Limited acquires more than 50% of the equity shares of the European company, then it will be, this European company will become a subsidiary of Jindal Polyester Limited, which is the parent. So it will obtain control over the European polyester manufacturing company, and that will be a business combination. So business combination is a transaction or other event in which the acquirer obtains control of one or more businesses. Now what is control? Because we are using the word control too often. So what is control? We'll of course come to now we are coming to the formal definition of control. Control over an investee arises when an investor is exposed or has rights to variable returns from its involvement with the investee company, and has also the ability to affect those returns through its power over the investee. So three things are very important for the control, for definition of control. One, the investor company must have power over the investee. The investor company is exposed to variable returns from its involvement or investment in the investee, and it has the ability to affect those returns through its power over the investee. First of all, it must have power over the investee. Second thing, it must be exposed to variable returns from its involvement in the investee company. And lastly, it has the ability to affect those returns, that variable returns, through its power over the investee. That is what is called control. Then we come to another important concept called non-controlling interest. It is the equity in a subsidiary that is not attributable directly or indirectly to the parent. So when in Jindal Polyester Limited acquires the European company or obtains a control over the European company, let's say by acquiring 60% of the shares of the European company, it obtains control. But 40% of the shares may be owned by other shareholders or other investors. That 40% is actually the non-controlling interest. It is the equity in a subsidiary that is not attributable directly or indirectly to a parent company. That portion of the equity of the subsidiary which is not directly or indirectly attributable or owned by the parent company is called non-controlling interest. So just to give a very rough example, crude example, like if Jindal Polyester Limited buys 60% of the voting shares or equity shares of the European company which it is going to acquire, then 40% shares will still be held by other investors, other shareholders of the European company, and that will be the non-controlling interest. So far as Jindal Polyester Limited is concerned, that is the non-controlling interest in that subsidiary. It is the equity in a subsidiary which is not attributable directly or indirectly to a parent. That is what is called non-controlling interest. Then we come to another very important concept. Of course, we have already discussed this concept earlier, goodwill. We have discussed it in more details, with great details in the earlier sessions. Goodwill. It is an asset which represents the future economic benefits arising from other assets acquired in a business combination that are not individually identified and separately recognized. So goodwill is an asset. Normally this asset is acquired through a business combination. Goodwill can also be internally generated, but as you know, internally generated goodwill cannot be reflected in the statement of financial position. Internally generated goodwill cannot be reflected or disclosed, cannot be measured. We cannot have any measure of the internally generated goodwill. So internally generated goodwill, even if it is there, it will never be revealed through any of the financial statements. But goodwill can, when in a business combination, when a company A buys another company B, it can acquire goodwill. It can purchase goodwill. So that goodwill which has been acquired by investment in a subsidiary company can be reflected in the balance sheet or the statement of financial position of the parent company. So it is an asset. It is reflected always as an asset normally, which represents the future economic benefits arising from other assets acquired in a business combination that are not individually identified and separately recognized. Assets which can be individually identified and separately recognized are basically the assets reflected in the balance sheet of the subsidiary company. There will be some assets which could be acquired, but that cannot be individually identified and separately recognized. That is what is called goodwill. So the acquired goodwill or the purchased goodwill will be reflected in the statement of financial position of the acquiring company or the parent company. Any questions? So what is a group consolidation? So we have a parent company which controls some foreign companies, foreign subsidiaries control some domestic subsidiaries. So the totality of this parent along with the foreign subsidiaries and the domestic subsidiaries, that actually comprise a group. Like there are various groups around us. Group of companies like Reliance group of companies, Aditya Birla group of companies. So there are various groups of companies which are there also in India. Okay, so there are one company in that group, one company is the parent, it has control over the remaining companies. So it's a parents and subsidiary relationship. Some of the subsidiaries could be foreign subsidiaries, some of the subsidiaries could be domestic companies. So on the totality of all this, the parent along with the subsidiary companies, both foreign and domestic, comprise the group. This slide depicts that holding company which is a subsidiary on the last day of the accounting period. The important thing is to remember is that subsidiary relationship should be existent on the last day of the accounting period. So this slide depicts that a holding company which is a subsidiary on the last day of its accounting period must prepare consolidated financial statements as per IFRS 10 requirements in addition to its own individual or separate financial statement which is required under IS 27. So the parent company not only will prepare its own individual or separate financial statement, that is statement of cash flow, statement of financial position, statement of profit and loss, statement of change, comprehensive income, other comprehensive income, statement of changes in equity and notes to accounting policy. That will be prepared by the parent company for itself. That is actually the separate or individual financial statements which will be prepared as per IS 27. Not only that, the parent company also will prepare, taking into account all subsidiaries which are there existent or were existing on the last day of the accounting period. For them, for taking their financial statements into account, those subsidiaries have also created their own separate financial statements. So parent will now consolidate its own separate financial statements with the separate financial statements of all subsidiaries which are subsidiaries of the parent company on the last day of the accounting period. So a company which has a subsidiary on the last day of the accounting period, which has one or more subsidiaries on the last day of the accounting period, must prepare a consolidated financial statement in addition to its own individual financial statements. So there will be a consolidated statement of financial position, there will be a consolidated statement of other comprehensive income or consolidated statement of comprehensive income, consolidated statement of changes in equity, consolidated statement of cash flow, and consolidated notes to accounting policies. So apart from having its own financial statements, the parent also must prepare a consolidated financial statement by consolidating its own financial statements with the financial statements of those companies which are subsidiaries of the parent as on the last day of the reporting period, and consolidate their financial statements with its own financial statement to present what is called a consolidated financial statement of the group. Okay, this is the requirement, so that is called group consolidation. Any questions? Parents which issues consolidated financial statement must consolidate all subsidiaries, foreign and domestic. So it must consolidate the financial statements of all subsidiaries, foreign and domestic. Subsidiaries means here subsidiary as on the last day of the accounting period. If the parent is A and B used to be a subsidiary company but ceased to be a subsidiary company on the last day of the accounting period, then there will be no requirement of consolidation of these statements, financial statements, into the consolidated financial statement. Supposing a company A used to have a subsidiary relationship, used to made an investment in another company B and had a control over B throughout the year, but it sold all the shares or sold a major part of the shares it owned in B before the last day of the accounting period, and B ceased to become a subsidiary of the parent company. As on the last day of the accounting period, B is no more a subsidiary of the parent. Then these financial statements will not be consolidated. So the subsidiary relationship must exist on the last day of the accounting period, that is on the balance sheet date. Then only consolidation is required. Otherwise, no. And parents which issue consolidated financial statement must consolidate all subsidiaries, foreign and domestic. The consolidated statements will be consolidated balance sheet, a consolidated statement of financial position, consolidated income statement, consolidated statement of changes in equity, consolidated statement of cash flow, and notes to accounting for the group as a whole. Any questions? So we will now look at some of the complex group structures to understand basically the parent-subsidiary relationship. We will look at some of the complex group structures to understand what we mean by a group. Let's look at the first example. Sometimes group structure can be very complex. As per the definition of IFRS 10, we have to look at the various kinds of group structures. Some of the examples of complex group structures we'll look at. Let's see the first example. A owns 51%, A is a company which owns 51% of the shares of B. And B owns 51% of the shares of C. The effective interest of A in C is 25%. 51% of 51%. If you look at what is the effective interest of A in C? Because A owns 51% of the shares of B, and B in turn owns 51% of the shares of C. So if you look at the effective interest of A on C, that comes to 51% into 51%, which comes to nearly 25%. So although A's effective interest in C is 25%, but it is in a position to control C through B. Because A controls B and through B it can control C because B owns more than 51% shares of C. You can understand control here. Because B owns more than 51% shares of C, so any decision taken by C, major decisions taken by C regarding dividend payment, etc., all these, since B has a majority of the shareholding in C, so B can, after all the decisions are taken through votings in a annual general meeting of the shareholders. Since B owns 51% shares of C, so all decisions of C can be influenced by B. B can effectively take decisions on behalf of C because it has a 51% voting rights, which can take care of any decision which will be taken as per directions of B or as per the wish of B. So A, although has only a 25% controlling interest on C because A owns 51% of B and B in turn owns 51% of C. So the effective interest of A over C is only 25%. But because A controls B and B in turn can control C, so A effectively controls C. So this is a, basically, we see there is a element of control available. A can control C through B. So this is one kind of a group. So will C be considered a subsidiary of A? Yes. C can also be considered a subsidiary of A because A has effective control or control over C through B. Although A may be having only effective interest of 25% in the shares of C. So this is one example. Second example we look at. So the substance of interest will require an inquiry if A doesn't have an effective control over C through B and is indicated as per IFRS 10, then C will be subsidiary, otherwise not. So basically it is not important always to have a directly 51% or more equity holding in the subsidiary company. What is basically we are interested to know whether A has an effective control over C through B. If it is there, then as per IFRS 10, C will be subsidiary. If A doesn't have an effective control over C through B, then C will not be considered as subsidiary. Okay. Then second one, A is the parent of B because A owns 65% shares of B. A is also a parent of C, although B only owns 40% of the shares of B. The shareholders having another 35% rights in C is under contractual obligation of voting directions from B. So B only holds 40% of shares of C, but another 35% of the shareholders in C, they are under contractual obligation of voting directions from B. So they will vote as per directions of B. So B effectively has a 75% control, 40% is ownership of shares in C, and it has also a contract with shareholders having 35% rights in C that they will vote as per directions of B. So basically B has an effective control over C. A is the parent of B. A is also considered as a parent of C, and it is at control of 75% of the voting rights of C through B. So here, unlike in the first case where B has a clear 51% owns 51% voting rights in C, here B doesn't own, only owns 40% of the voting rights in C. But it has but the 35% of the shareholders having 35% of the shares in C, they are under a contractual obligation with B to vote as per directions of B. So B effectively has a 75% control of the voting rights in C, and through B, A has a 75% control over the voting rights in C. So it is also considered a group, so C will be considered a subsidiary of A. So A will be the parent of both B and C. Then comes third example, structure. Here A owns 65% of shares of B, A also owns 65% of the shares of C. Another company D owns 25% of the shares of B, and 25% of the shares of C. Now it is a clear case where A controls B as well as A directly controls C. Because A has 65% of the voting rights in B, it has also 65% of voting rights in C. So it has direct control over both B and C. So both B and C will be considered as subsidiaries of A. So A is the parent of both B and C. Like in the other cases, where the subsidiary relationship between A and C is established through B. Here there is subsidiary relationship between A on one side and B and C on the other side. It is a straight, direct subsidiary relationship. Now we will come to some more complex group structure. I hope these three examples are clear to you. Any questions on this control? Whether A has control over B and C, whether B and C should be considered a subsidiary of A. If you have any doubts, please raise it now, because we are discussing some of the complex structures. So let's understand the parent-subsidiary relationship. It is basically based on control. Of course, voting rights gives you a direct control. If you have more than 51% of the voting shares in another company, it gives you a direct control. But sometimes you may not have a 51%, may not be owning 51% shares in another company, but still you may control through contractual obligation with other shareholders, etc. So you may still control the voting rights in C. So control is still possible without even having 51% or more voting rights in the subsidiary company. Some of the other examples we look at. A owns only 15% of shares in B. But A has a contractual arrangement with owners of B to control the entity. So purely on the basis of ownership of 15% of shares in B, we cannot say B is a subsidiary of A. But A has a control through a contract with the B's owners. That means owners of more than 51% shares of B. So if A has a contractual, if he has a contract or B's owners are under a contractual obligation with A, then if there is a contractual arrangement with owners of B to control the entity, then still also we can call B as a subsidiary of A. Provided the important point here is the control. So we will go into definition of control in more details afterwards. But important point is to understand the control. Control can be obtained either through ownership of more than 51% shares of the investing company, or control can be also obtainable, or control can also be available through other means, like a contractual obligation with the owners of a large block of shares in the investing company. Okay, so control can, there can be various ways control can be, control can exist. The last one we'll see, A and B, two different companies, but same group of shareholders own A, and those same shareholders own 100% of shares of B. So A and B basically are two different companies, but the shareholders are common. Same group of investors are owning shares of A and shares of B. Should we consider it as A as a subsidiary of B or B as a subsidiary of A? So they have common shareholders, that's all. A and B have common shareholders, so will it be considered a parent-subsidiary relationship? There is no group in this situation, as both A and B fall within the ownership of common shareholders, which is not in the definition of, within the definition of IFRS 3 or IFRS 10. So both A and B they fall within the ownership of common shareholders. So there is no group situation here. Although the shareholders are same, the same group of shareholders own 100% of A and 100% of B, but there is no group situation here. So we will come to definition of control. How do we define control? An investor controls an investee when the investor is exposed or has rights to variable return from its involvement with the investee and has the ability to effect those returns through its power over the investee. So three elements are important to establish the existence of control. Number one, investor must have power over the investee. Investor is exposed to variable returns from its investment in the investee. And thirdly, investor has the ability to use its power over the investee to effect those returns. These three elements are important to understand what is control. Number one, investor must have power over the investee. Some degree of power over the investee. The investor is exposed to variable return from its investment in the investee. Like variable return means supposing a company has a company like Jindal Polyester invests in the European company. So when it invests in the European company, it will be exposed to variable return from its investment because the investee company, the European company, will make different profits, different kinds of performance in different years. Based on that, the dividends that will be paid to the owners can vary from year to year. If the performance varies from year to year, so also dividend percentage or dividends paid to the shareholders can vary from year to year. So the investor company is exposed to variable returns from its involvement in the investee. And thirdly, the investor company has the ability to use its power over the investee to change those returns. So these three things are very important to understand and control. So an investor controls an investee if and only if the investor fulfills all the following points. Number one, it has power over the investee. Number two, it has exposure or rights to variable returns from its involvement with the investee. And thirdly, it has the ability to use that power over the investee to affect the amount of the investor's returns. These three things are very, very important. So power is the investor has power over the investee. The investor has rights, giving it the ability to directly participate in the activities which significantly affect returns from the investee. That means participate in the activities which significantly affect returns from the investee can be participate in the board meeting, board of directors meeting, where decision is taken regarding how much dividend is going to be paid to the shareholders. So if the investor has the power of the investee, if the investor has the rights, that means giving us the ability to directly participate in the activities which significantly affect returns from the investee. In many straightforward situations, power is gained. How the power is gained? Power is normally gained by holding more than 50% of the voting rights in the investee. If more than 50% of the voting rights in investee is acquired, then you get the power. But even without acquiring more than 50% of the voting rights, you can still have power, like the examples we talked about, where the investor company, there is a contract between the investor company and a group of shareholders or a block of majority shareholders in the investee company, that they will be voting according to directions of the investor company. Like A has invested, has obtained 40% of the voting rights in B, but it has entered into a contract with a shareholder who has 35% of voting rights in B, that he will vote as per directions of A. Then although he has not acquired more than 50% of the voting rights in B, but still because of that contract with the 35% owners of B, which is basically that they will vote as per directions of A, still power is gained over B. So power, in most normal, in the straightforward situation, is having more than 50% of the voting rights of B. If you are having more than 50% of the voting rights in any company, you definitely have the power. Because after all, a shareholder who has got more than 50% of the voting rights in any voting situation, it can always, with the help of that more than 50% voting rights, it can always pass or oppose a resolution which it supports or doesn't support. Because they have the voting rights. So power over the investee is basically if the investor has the rights, giving it the ability to directly participate in the activities which significantly affect returns of the investee. In many straightforward situations, power is gained by holding or acquiring more than 50% of the voting rights in the subsidiary. But it can also be gained otherwise. That's what I am trying to point out. It is not necessary that every time you can gain power just by acquiring more than 50% voting rights. Yes, if you have more than 50% voting rights in another company, yes, power is gained. But even without having more than 50% of the voting rights, still power can be, the investor company may have power over the investing company because of other circumstances. Like say, a contract with 30% owners of the company that they will vote as per directions of the investor company. Then 40% plus 30% makes 70%, so 70% voting rights is effectively available to you. So even without having acquired more than 50% voting rights, an investor company has power over the investing company. That is what I am trying to emphasize. Second is variable returns. The second concept is variable returns. An investor is exposed to variable returns from the investee when there is potential for variable performance from the investee. If there is a potential for variable performance from the investee, the returns from the investment also will vary from year to year. So an investor is exposed to variable returns from the investee when there is a potential for variable performance from the investee. In other words, the returns, dividends and profits from the investee will depend on the performance of the subsidiary. There will be no fixed right to a specific return. Having invested in another company, having acquired more than 51% of the voting rights in another company, there is no guarantee that you will always get a particular return every year. It will depend on the performance of the investing company. And the performance of the investing company can vary from year to year. So that way your return on investment will may also vary from year to year. The dividend received from the investing company on your investment can vary from year to year. So the investor company is exposed to what we call variable returns from the investee when there is a potential for variable performance from the investee. In other words, the returns like dividends and profits from the investee will depend on the performance of the investee. There will be no fixed right to a specific return. And third thing is ability to use the power to affect the returns. The investor will not only have power and exposure to variable returns, but must also have the ability to use that power to affect the returns from the investee. So an investor with decision-making rights determines if it is acting either as a principal or as an agent. The investor will only control its investee if it is acting as a principal. The investee will control the investee only if it is acting as a principal, not as an agent. And an agent would need powers delegated to it by controlling body. So the ability to, important thing, not only having the power, not only being exposed to variable returns, but it should also have the ability to use power to affect those variable returns. So that means basically investor with decision-making rights. So it can take decisions on behalf of the investing company. If it can take decision on behalf of the investing company, or it can impose its decision on the investing company so far as the running of the investing company is concerned, then it is actually able to use the power to affect the returns. So here the investor company must act as a principal, not as an agent. Because an agent always acts on behalf of somebody else. It acts within the scope of delegated powers. Here the investor company must be able to act as a principal. It can participate in the decision making, it can influence the decision making in the investing company so that the variable returns or performance of the investing company can be controlled by or can be basically as per decision of the investor company. So it has the power, it is able to use its power effectively to affect those variable returns. So these are the three elements of control. Please be very clear about these three essential elements of control. So one is having power over the investing company, Second is exposure to variable returns from the investment in the investing company. And third is the ability to use the power to affect those variable returns. These three are essential elements of control. Now the key points we have to consider in group accounting or consolidation of group financial statements. A parent will prepare a consolidated financial statement in addition to its individual financial statements. So if A is the parent company or the holding company, B, C and D are subsidiaries, each of these four companies A, B, C and D will prepare their individual financial statements separately. In addition to preparing its own or individual financial statement, A, the parent company, yes, what is the question from Shivam? Let me see. No questions? Okay. In addition to preparing its own financial statements, A, the parent company will also will consolidate the financial statements of B, C and D, the subsidiaries, and its own financial statements into one single financial statement that will present the financial performance of the group as a whole as a single economic entity. That is called consolidated financial statement. So the task of preparing the consolidated financial statements will lie with the holding company or the parent company. So a parent will prepare a consolidated financial statement in addition to its individual financial statements. Uniform accounting policies will be used. Same accounting policy should be used in preparation of consolidated financial statement as well as individual financial statements. Same accounting policies should be used. The financial statements of parent and subsidiary are drawn up to the same reporting date. So because the financial statements of the parents as well as the subsidiaries B, C and D, A is the parent, B, C and D are subsidiaries. The financial statements of each of A, the parent company, B, C and D, the subsidiary companies, uniform accounting policy, there cannot be different accounting policies. So the B is preparing, let's say, B is preparing its financial statement using some other accounting policies. The accounting policies are chosen. Which accounting standards to be used? What are the various, maybe the methods of depreciation, methods of inventory valuation? These are all part of the accounting policies. So we have discussed accounting policy earlier. So I do not want to go back to the basics again, the uniform accounting policy. My point is whatever accounting policy is followed by the parents, the same should be followed by the subsidiaries. And in preparation of the consolidated financial statement, the same accounting policy should be followed. So uniform accounting policies are used in preparation of the consolidated financial statement as well as the separate financial statements. The financial statements of the parent and subsidiary should be drawn up to the same reporting date. So the parents and the subsidiary should prepare their financial statements on the same reporting date. Then consolidation will be possible. So the financial statements of the parent and the subsidiary should be drawn up to the same reporting date, and the consolidated financial statement also will be prepared for the same reporting date. It should begin when an investor obtains control. So we will consider only the period when investor has obtained control. If it is the control is for 1 day, it is for only 1 day. We'll talk about the performance of the subsidiary company for 1 day only. Supposing a company A acquires another company B on 31st December, that is the reporting date. So we'll have to take into account for consolidation of financial statements, we have taken into account the performance of 1 day only of B to be consolidated into the group financial statements. So it begins when an investor obtains control over the subsidiary companies. It ceases when an investor loses control. If the investor loses control, that means it doesn't have any more control over the subsidiary company, it will cease. Proportionate profit or loss and changes in equity is allocated to parent and non-controlling interest. So subsidiaries profit and loss, Supposing the parent company owns 60% of the subsidiary. Now supposing the profit for the subsidiary is for a particular reporting period is 10 million, then 60% of the 10 million will be allocated to the parent and 40% will be allocated to the non-controlling interest. So proportionate profit or loss and changes in equity is allocated to the parent and non-controlling interest. If the parent company owns 100%, then entire 100% will be allocated to the parent. But if the parent company owns 60% of the shares of the subsidiary, then 60% of the profit or 60% of the changes in various equity components will be allocated to the parent company, and remaining 40% will be allocated to the non-controlling interest. The consolidated financial statements should be prepared using uniform accounting policies for similar transactions and events. That is the question of Shubham. So for similar transaction and events, same accounting policy should be followed across subsidiaries and the parent. If a member of the group uses different accounting policies in its individual financial statements, supposing it's a foreign subsidiary, supposing the parent company is in UK and the subsidiary company is in US. Now the UK company prepares its financial statements complying with IFRS, whereas the US company may prepare its financial statements following US GAAP. So if a member of the group uses different accounting policies in its individual financial statements, perhaps it is a foreign subsidiary using a different generally accepted accounting principles, a US GAAP, then the results must be adjusted to reflect the group policy before incorporating the subsidiary's result into the group. So now I think, Shubham, you can understand the answer to your question. Supposing we have a situation where the parent company is a company based in UK and the subsidiary company is a company based in USA. Now the parent follows IFRS. The accounting standard followed by the parent is IFRS, and that followed by the US company is US GAAP. Now when you are going to consolidate the financial statement of the prepared by the US subsidiary into the consolidated group financial statement, you have to adjust that financial statement, because all other members of the group, the parent or maybe other subsidiaries, they have all prepared their financial statement based on IFRS. Only one company, which is subsidiary, is operating in US, they have prepared their financial statement using US GAAP. So the financial statements of the US subsidiary has to be adjusted. Results must be adjusted. Profit and loss number has to be adjusted to reflect the group policy before incorporating the subsidiary result in the group. So by following IFRS, now there will be additional items. Using IFRS, the results of the profit and loss, etc., of the group company will be reworked. Then it will be consolidated into the group results. So we cannot just take the profit and loss prepared as per US GAAP. You have to basically readjust or rework the financial statement prepared by the subsidiary which is operating in US and prepared the financial statement as per US GAAP. Now the parent, before consolidation of the US subsidiary's financial statements, has to rework the results using IFRS, because that is the standards being used by the parent and all other subsidiaries. That is the meaning of uniform accounting policy. Does this answer your question? So before incorporating that US subsidiary result into the group accounts, it must be adjusted to reflect the group policy. Group policy is to follow IFRS. That is the group policy. But one subsidiary is following a different GAAP. So in that case, you have to do an adjustment before incorporating the subsidiary result into the group. So does it answer your question? Shivam Sharma. Shivam. So are you clear on this or not clear? Shivam Sharma from Delhi South Extension. Are you clear on this particular point? Have I clarified your doubts with that example I have told you? Thank you very much. Now the financial statement of the parents and the subsidiaries used in the preparation of the consolidated financial statements are usually drawn up to the same date or same balance sheet date. But sometimes it may happen. Sometimes it may happen they have different financial year or accounting year. A company operating in US may have accounting year from 1st January to 31st December, where the parent company operating in India can have financial year starting from 1st April to 31st March. It is possible. The financial statements of the parents and the subsidiaries used in the preparation of the consolidated financial statements are normally drawn up to the same balance sheet date. If they have a different financial year, then either the subsidiary must prepare special statements as at the same date as the group. Supposing the subsidiary has financial year ending on 31st December, whereas the parent has financial year ending on 31st March. Then in that case, subsidiary will draw up special statements as at the same date as the group, that is 31st March. Or if it is impracticable to do this, financial statements drawn up to different reporting dates may be used if the difference is no greater than 3 months. If it is more than 3 months, no. Sometimes it is impracticable to prepare special statements as at the same date as the group. So in that case, financial statements drawn up to different reporting dates may be used if the difference is no greater than 3 months and adjustments are made for effects of significant transactions or other events which occur between those dates and the date of the parent's financial statement. So if the US company has prepared financial statements as on 31st December and the parent company, an Indian company, has prepared financial statements up to 31st March, if the period doesn't exceed 3 months and it is impracticable to create special statements up to 31st March for the US subsidiary, it is impracticable to do that. In that case, the financial statements drawn up to 31st December can be used, and secondly, adjustments should be made for effects of significant transactions or other events which occur between 31st December and 31st March. Okay, that is the rule. The results of operation of a subsidiary are included in the consolidated financial statement as from the date the parent gained controls of the subsidiary. We are not bothered about the results of the subsidiary company prior to parent gaining control over the subsidiary. The results of performance or operations of a subsidiary will be included in the consolidated financial statements as from the date the parent gains control over the subsidiary. The results of operations will be included by the parent in consolidated financial statements until the date of disposal, which is the date on which the parent ceases to have control over the subsidiary. Okay, and of course the last thing is, proportionate profit and loss and changes in equity will be allocated to the controlling interest of the parent and non-controlling interest of the minority shareholders. So these are the key points regarding consolidation of financial statements. If financial statement of the holding and subsidiary are drawn up to different dates, then as I explained to you, either the subsidiary must prepare special financial statement at the same date as the group, they can do it, or if it is impracticable, then the financial statements will be drawn up to different reporting dates, and if the difference is not greater than 3 months, then adjustments are made for significant transactions between the two dates. Now we'll talk about the difference between IFRS and US GAAP so far as this area, consolidation of financial statements, is concerned. So first area we'll discuss is exemption from consolidation. Under IFRS, there is limited exemption from preparing consolidated financial statements for a parent company that is itself a wholly owned or partially owned subsidiary, if certain conditions are met. Also, there is industry-specific exemption, that is investment company. So there is limited exemption from preparing the consolidated financial statements for a parent company which itself is a wholly owned or partially owned subsidiary. That means B is a company which is and C and D are subsidiaries of B. Now B can be itself a wholly owned or partially owned subsidiary of A. In that case, there will be limited exemption available to B in preparing consolidated financial statements. Certain conditions have to be met. There could be also industry-specific exemption, that is, investment companies, they are also exempted. Under US GAAP ASC 810, there is no such exemption, but industry-specific exemption is available, that is for investment companies. Now, secondly, regarding accounting policies. Under IFRS, uniform accounting policies between the parent and subsidiary is mandatory. No exception. So, the parent and subsidiary must follow uniform accounting policies. Under US GAAP, uniform accounting policies between parent and subsidiary is not mandatory, so the parent and subsidiary can follow different accounting policies. Then consolidation approach, area of consolidation approach. Under IFRS, it provides a single control model for all entities. Under US GAAP, it recommends for primarily two consolidation models, variable interest and voting. The variable interest model evaluates control based on determining which party has the power and the benefits. The voting model evaluates the control based on the existing voting rights. So there are two models here. All entities are first evaluated as potential variable interest entities. If an entity is not a variable interest entity, it is evaluated for control purpose to the voting model. So first it will be evaluated to the variable interest entities and then voting model. And last area is basically consolidation, different reporting dates. When the parent and subsidiary have got different reporting dates, how consolidation is to be made. Under IFRS, the financial statements of a parent and its consolidated subsidiaries are prepared as of the same date. When the parent and the subsidiary have different reporting periods and dates, the subsidiary prepares for consolidation purpose additional financial statements as of the same date as of the parent unless it is impracticable. Under US GAAP ASC 810, holding and subsidiary are permitted to have difference in reporting dates up to 3 months. Significant events, if any, between this period are disclosed in the financial statements. So, US GAAP itself allows a difference in reporting dates up to 3 months between holding and subsidiary, and all significant events between this period will be disclosed in the financial statements. So these are the areas of differences between US GAAP and IFRS so far as consolidation of financial statements or group accounting is concerned. So we'll have a short break at this point of time. As you know, today our classes will continue till 1 p.m. So we'll have a break at this point of time, short break before we proceed to the next lesson. But basically what we have learned here, we want to summarize. A company which has a subsidiary on the last day of its accounting period must prepare consolidated financial statement in addition to its own individual financial statement. This is a requirement of IFRS 10. Separate financial statements are those in which the investments in subsidiaries, associates and joint ventures are accounted for at the cost or at fair value in accordance with the IFRS 9. An investor controls an investee when the investor is exposed or has rights to variable return from its involvement in the investee and has its ability to effect those returns through its power over the investee. So three things are important. The investor must have power over the investee. It must be exposed to variable returns from its involvement or investment in the investee. And thirdly, it has the ability to use the power to effect those returns. So these are the 3 points to be considered regarding control. So we'll have a short break at this point of time and then we'll proceed to the next lesson. If you have any questions, you can ask at that point after the break. Welcome back after the break. Now, if you have any question, we have so far discussed only the key concepts regarding consolidation of financial statement of a group. We talked about control, how a group and subsidiary relationship, parent company and subsidiary relationship is defined by control that the parent has over the subsidiary, and the requirement of consolidation at the level of the parent. Consolidation of financial statements of the parent and the subsidiaries into one single financial statement, which represents the performance of the group, entire group as a whole. So in this section, we'll be going into a little more details, having understood we had an overview basically, having understood the key concepts. So we'll go into a little more details regarding consolidation of financial statements. So we'll see how computation of goodwill and non-controlling interest calculation are carried out in the procedure for consolidation. We'll try to understand the comparative position between subsidiary, associate and joint venture. Identify where the significant influence exists and apply the equity method of accounting for associates, investment in associates and joint ventures. Now, in the consolidation procedure, two things we have to look at. One is the non-controlling interest subsidiary acquired, and first step in performing consolidation requires these three elements, that is goodwill, non-controlling interest and net assets of subsidiary acquired on the date of acquisition. So these are three very important concepts we will discuss now. Next step is that the balance sheet items are consolidated fully on line by line item basis. The entire procedure of consolidation are detailed and quite complex. So our course exposure is limited to the procedures to understanding the key aspect, that is goodwill in acquisition and non-controlling interest of minority. So we will not go into detailed procedures of consolidation, which is beyond the scope of this particular course. So we will talk more about goodwill in acquisition and non-controlling interest in minority. So we will talk about first purchase consideration. When a company acquires another company, it pays a consideration. When a company A acquires company B, it has to pay a consideration for acquiring the certain percentage of shares of B. Let's say a company has acquired 60% of shares of another company B. Now for acquiring the 60% shares of B, it has to pay a purchase consideration. So purchase consideration is essential for calculating goodwill. So fair value of the cost of acquisition or purchase consideration could be the amount of cash or cash equivalents paid to acquire 60% of shares, let's say, of the other company. Or fair value could be through other purchase consideration, like say a company A acquires 60% shares of B by issuing its own shares to those shareholders of B from which they acquired those 60% of shares. So the fair value of the shares which have been issued for acquiring 60% of shares of B, that will be the purchase consideration. So purchase consideration paid directly by amount of cash or cash equivalents to the owners of those 60% shares, or it could be paid by issuing shares of A to the owners of 60% of shares of B. I am just taking an example where 60% of the shares of B is acquired by company A. So two ways the shares can be acquired, either by paying cash or cash equivalents to the shareholders of B who sold those 60% shares of their holding to A, or it could be in exchange of cash or cash equivalent. In exchange of that, in lieu of that, company A may have issued shares, its own shares, to those shareholders of B who have agreed to sell their shares in B to A. So that is fair value of the cost of acquisition or purchase consideration. Then there can be contingent consideration. Contingent consideration is basically a consideration which will be paid if certain contingencies arise. Based on certain contingencies, additional consideration may be paid. That is called contingent consideration. So purchase consideration is basically essential for calculating goodwill. Purchase consideration is measured at the fair value of all the elements to determine the value of the goodwill on acquisition date. If share exchange takes place, then fair value of the number of shares of parent company paid to subsidiary is taken into account. Elements of purchase consideration can be cash, can be shares of parent, can be cash equivalents, either as current or contingent consideration or deferred consideration. Contingent consideration, deferred consideration will be defining in the next slide in more details. Deferred consideration is the consideration which will be paid on a future date. So present value of the consideration likely to be paid on a future date is taken as the deferred consideration. Any cost directly associated with the acquisition process will be expensed to profit or loss as a period cost. So an expenditure incurred by the company A while acquiring, let's say 60% shares of B, will be expensed in the profit and loss account of A as a cost for that period. So it will be expensed to profit and loss as a period cost. So contingent consideration when a business combination agreement provides an adjustment to the cost contingent on future events. For example, certain levels of profit or value of shares. So the agreement between the acquiring company and the shareholders of the acquired company who are selling their shares to the acquiring company provides for some adjustment to the purchase consideration contingent on future events like certain levels of profit earned by the acquired company or certain value of shares. If that contingency is fulfilled, then only that adjustment to the purchase consideration will be made. This is called contingent consideration. Deferred consideration is the cost of acquisition to be paid on a specific future date. It may be at a premium or at a discount. So whenever there is deferred consideration involved, that means any consideration which is payable on a future date, you have to take into account the present value of the deferred consideration on the acquisition date. Now what is non-controlling interest? Next we come to the concept of non-controlling interest. It represents a portion of the net assets of the subsidiary that belongs to the investor from outside the group. So the portion of the net assets of the subsidiary, net assets we clearly understand assets minus liabilities attached to those assets. So net assets of the subsidiary, portion of the net, the company may not have acquired 100% of the shares of the subsidiary. So the net assets of the subsidiary which belongs to the investor from outside the group, that is called non-controlling interest or minority interest. So IFRS 3 permits alternative ways of NCI calculation, how to calculate the non-controlling interest. So IFRS 3, it permits alternative ways of NCI calculation. One way is to proportionate share of the fair value of the subsidiary's net assets, or fair value, the second alternative is the fair value based on the market value of the shares held by the NCI. So either it can be proportionate share of the fair value of the subsidiary's net assets, which are attributable to the non-controlling interest of minority shareholders, or fair value based on the market value of the shares which is held by the non-controlling interest or investors outside the group. NCI is also called as minority interest in other accounting standards, like say in India, in AS, that is the accounting standard which is followed in India, the other name for non-controlling interest is minority interest. So sometimes we may come across the word minority interest instead of non-controlling interest. They are basically one and the same. NCI has to be shown in the consolidated balance sheet below the equity elements on the liability side of the balance sheet. the non-controlling interest must be reflected in the consolidated balance sheet below the equity elements on the liability side of the balance sheet, and similarly NCI profit share will be shown in the net profits below the net profits in the consolidated income statement. So in the consolidated income statement and consolidated balance sheet, non-controlling interest must be disclosed below the equity elements on the liability side of the balance sheet or below the net profits in the consolidated income statement. So now let's set the two methods of calculating NCI. We'll look at examples illustrating the two methods of calculating NCI, but before that we'll talk also of the other important element, that is goodwill. Goodwill is the excess of the amount transferred plus the amount of NCI over the fair value of the net assets of the subsidiary. Goodwill is nothing but the amount transferred by purchase consideration plus the amount of NCI over the fair value of the net assets of the subsidiary which has been acquired, and on the acquisition date. The fair valuation will be done on the date of acquisition. So acquisition date, fair value of the consideration transferred, add amount of the NCI on the entity acquired minus acquisition date fair value of the identifiable assets acquired and liabilities assumed measured in accordance with IFRS. See, that gives us the goodwill. So goodwill is nothing but the difference between the sum of the acquisition date fair value of the consideration transferred and the amount of NCI in the entity acquired minus the acquisition date fair value of the identifiable assets acquired and liabilities assumed measured in accordance with IFRS 3. So goodwill is nothing but an asset representing the future economic benefits arising from other assets acquired in a business combinations which are not individually identified and separately recognized. So goodwill in consolidation is the difference between the value of the business taken as a whole and the fair value of its separate net assets. So goodwill in consolidation will be the difference between the value of the business taken as a whole and the fair value of the separate net assets which are identifiable and separately recognized. So goodwill with NCI, with both NCI, so consideration transferred plus NCI at fair value or NCI at proportionate of net assets minus fair value of net identifiable assets. So consideration transferred by the parent company for acquiring the subsidiary company plus will add NCI. NCI can be calculated at fair value of the shares which are held by the non-controlling interest or minority shareholders, or NCI can be calculated at proportionate of the net assets minus fair value of net identifiable assets will provide us goodwill with NCI either calculated in one way or the other way. Goodwill is calculated with two approaches. So we are calculating goodwill using two approaches. In one approach, NCI is taken at fair value of the shares held by the non-controlling or minority shareholders, or where the NCI is calculated at proportionate share in net assets of the subsidiary. Both are easy to apply, so we'll see with some examples in the following slides, in subsequent slides. Let's look at this example. NCI at fair value of net assets. P purchased 75% of S when the fair value of the net assets of S was 1,000. The NCI is 25% naturally, the minority shareholders' interest is 25%. So their share of net assets of S at the date of acquisition was 250. That is the calculation of NCI. This gives goodwill of 750. Because purchase consideration for the shares acquired is 1,000. NCI at the date of acquisition is 25% of the net assets of fair value of the net assets of S, that is 250. So 1,250 minus fair value of the net assets of subsidiary acquisition is 1,000. So 250 is the goodwill. So goodwill we know is the purchase consideration for the shares acquired by the investor company or the parent company plus NCI as on the date of acquisition. Now the fair value of the net assets of the acquired company or the investee company being 1,000, NCI based on net assets is 25% of 1,250. So purchase consideration for the shares acquired is 1,000. NCI on the date of acquisition is 250. So 1,250 is the total. Minus the fair value of the net assets on the date of acquisition is 1,000. So 250 is the goodwill. Second question. I think the second question is actually same as the first one. Now there is a variation here. Suppose the fair value, same example, P purchased 75% of S and the fair value of the net assets of S was 1,000. The NCI is 25%, so their share of the net assets of S at the date of acquisition was 250. This gave us the goodwill of 250. Suppose, not 750, 250. Suppose the fair value of the NCI at acquisition was given as 300. And further, suppose that is P's decision to measure NCI at acquisition in this way, fair value of the NCI at acquisition was 300. Contingent liability will not be present here. So how can contingent liability is not a balance sheet item? So when you talk about the net assets or fair value of the net assets, contingent liability will not be available in the financial statement or the statement of financial position. Contingent liability will be available in the footnotes of the financial statements, but it is not. Contingent liability or contingent assets are not part of the statement of financial position. So contingent liability will not be presented in the financial statement. No financial statement presents the contingent liability, I mean statement of financial position. It only comes out through notes to financial statements. Of course it is disclosed, but it will come in the form of notes to financial statement. We have already discussed contingent assets and contingent liabilities. So contingent assets and contingent liabilities are never a part of the statement of financial position, but they will be disclosed through notes to financial statements. Now purchase consideration for the shares acquired in the second case is 1,000. NCI, fair value of NCI on the date of acquisition is 300, so the total is 1,300. And fair value of the net assets of subsidiary at the acquisition date is 1,000. So goodwill will be 300. So basically we are, in same example, we are using two different NCI. One is the fair value of the net assets or NCI. One is the NCI as a percentage of the fair value of the net assets, or NCI as the fair value of the shares which are controlled by the non-controlling interest. So if the fair value of the shares which are controlled or owned by the minority interest is 300, then purchase consideration paid for the acquisition is 1,000 plus non-controlling interest measured at fair value is 300. So 1,300 minus the fair value of net assets of the subsidiary acquisition is 1,000. So goodwill will be 300. So under these two methods we are getting two different results of goodwill, because in one case we are taking NCI at the fair value, a proportionate value of the fair value of the net assets. In the other case we are taking NCI as market value, fair value of the fair market value of the shares owned by the non-controlling interest. So only two methods are there. Both methods, any of the methods can be applied for calculation of goodwill. But basically whatever methods are used for determining or calculating NCI, ultimately it is consideration transferred plus NCI either at the fair value of the shares which are held by the non-controlling interest, or NCI at proportionate of the net assets fair value minus fair value of net identifiable assets of the acquired company. This will give us goodwill. Okay. So you have seen two examples of the same acquisition, but calculating NCI in using different methods, and the goodwill numbers also will be different based on the NCI calculation. So goodwill treatment of the goodwill. Goodwill arising on consolidation is one form of purchase goodwill and is governed by IFRS 3. So goodwill arising on consolidation is basically a purchase goodwill, acquired goodwill, and it will be governed by IFRS 3. Second thing is goodwill is never amortized. As we have discussed earlier when we talked about the accounting standards relating to goodwill, goodwill is never amortized. Goodwill arising on consolidation should be capitalized in the consolidated statement of financial position and reviewed for impairment every year. See, other intangible assets which have got a finite life, they can be amortized, but goodwill is acquired during business combination, that's purchase goodwill, it should never be amortized. Secondly, goodwill arising on consolidation should be capitalized in the consolidated statement of financial position, and it should be reviewed for impairment every year. If there is an impairment of goodwill, once a goodwill is impaired, the impairment of the goodwill can never be reversed subsequently. If there is an impairment of goodwill, because goodwill has to be reviewed every year for impairment, and if there is an impairment of goodwill and impairment entry is passed, then subsequently that impairment cannot be reversed. So these are the goodwill treatment for goodwill. This we have discussed when we covered IS 30, the session for intangible assets. Sometimes there can be negative goodwill. What does it mean? Purchase consideration is greater than the net assets acquired. Sorry, it's actually wrong. There's a typo mistake here. Purchase consideration is less than the net assets acquired. So a company has acquired another company, but paid a purchase consideration which is less than the fair value of the net assets of the acquired company. In that event, if we calculate goodwill, it will be definitely negative, because after all, goodwill is purchase consideration plus non-controlling interest minus fair value of the net assets. Now, if the purchase consideration itself is less than the fair value of the net assets acquired, there can be situations where the difference can be negative. So that is called negative goodwill. It is referred under IFRS as actually gain on bargain purchase. Under IFRS 3, such negative goodwill is referred as gain on bargain purchase. How to deal with that? You have to identify if there is any error that has happened. Why a negative goodwill is coming? So identify any errors, that is reassess the amounts at which it has been measured, both the cost of combination and the acquiree's identifiable net assets. Any excess remaining, that is gain, is recognized in profit and loss. So negative goodwill will be ultimately covered through profit and loss. Thus, when purchase consideration less than the net assets of the business acquired, then it is form of a gain on purchase. It will be treated as a gain on profit and loss. In real scenario, we can see that when the business acquired is sick, we come across negative goodwill or gain on bargain purchase, particularly when a company A is acquiring another company B and paying less as purchase consideration less than the fair value of the net assets of the company. That happens when A is taking over a sick company. When A takes over another company B which is sick, they may pay even less than the fair value of the net assets of B. There will be a gain for A on bargain purchase. So that is why negative goodwill may arise, but this will be treated as a gain. It will be recognized in the profit and loss account in the year of acquisition. So when purchase consideration is less than the net assets of the business acquired, then it is a form of a gain on purchase. It can be seen in real scenario when the business acquired is a sick business. That is why it is called negative goodwill having trade balance. But as I told you, we have to first identify any errors, that is reassess the amounts at which it has measured both the cost of the combination and acquiree's identifiable assets, and any excess remaining, that is gain, will be recognized in the profit and loss account. in the year of acquisition. So journal for the goodwill impairment, and goodwill impairment takes place if NCI is at a proportionate method, proportionate of the net assets method, then we will debit group retained earnings account and credit goodwill account. So journal for the goodwill impairment, how we will journalize the goodwill impairment entry? We have to debit goodwill retained earnings, group retained earnings account and credit the goodwill account to the extent of the impairment. If NCI is valued at the fair value, that is fair market value of the shares held by the non-controlling interest, the goodwill in the statement of financial position will include portion attributable to NCI. Then we will have to allocate the goodwill impairment between the majority interest and also the minority interest. So if NCI is measured at fair value, that is fair market value of the shares owned by the non-controlling interest, then the goodwill in the statement of financial position will include portion attributable to NCI. So journal entry will be debit group retained earnings account, debit NCI's percentage share and credit goodwill account. So the treatments will be different depending on whether NCI is at a proportionate method or NCI is valued at a fair value. If the NCI is at a proportionate method, if the NCI was calculated at using the proportionate proportion of the fair value of the net assets of the acquired company, then the goodwill impairment will be debited to the group retained earnings account and credited to the goodwill account. But if the NCI was valued at the fair value or fair market value of the shares held by the minority shareholders, then the goodwill in the statement of financial position will include portion which is attributable to non-controlling interest. So journal entry will be debit group retained earnings account, debit NCI's percentage share. Supposing the goodwill is impaired to the extent of 5 million and NCI share is 20%, then 4 million will be debited to the group retained earnings account, 1 million will be debited to the NCI shares, and we will be creating goodwill account with 5 million. As per IFRS 3, as you know, once recognized goodwill must be tested annually for impairment, and any fall in value will be recognized as an expense in the consolidated profit and loss. So NCI on the date of reporting will be NCI on the date of acquisition, supposing XXXX amount, add NCI shares of post-acquisition profit, then less NCI shares of the goodwill impairment, if any, and NCI on the date of reporting. So NCI will be updated. NCI as on date of acquisition, whatever number is there, add NCI share of the post-acquisition profit, it will be added to the NCI's number for the date of acquisition, then it will be reduced by NCI share of the goodwill impairment, which will happen when NCI is measured at fair value, and then we arrive at what is called NCI on the date of reporting. So NCI is calculated both on the date of acquisition and date of reporting. On the date of acquisition, we will calculate the NCI using one of the two methods, proportionate method or fair value method. And again, it has to be recalculated on the date of reporting, because we have to add the NCI shares of the post-acquisition profit, we have to reduce it by the NCI shares of the goodwill impairment, and then we arrive at NCI as on the date of reporting. So NCI is calculated both on date of acquisition and on date of reporting. NCI on acquisition date you have already seen, which is either at fair value or at proportionate share of net assets. NCI on reporting date is given on this slide. So having discussed consolidated financial statements and particularly two very important concepts like non-controlling interest and goodwill, now we will go to investment in associates and joint ventures, for which the guidance is provided under IS 28. So associates and joint ventures we are going to talk about investment in associates and joint ventures, because investment in associates and joint ventures will not require any consolidation. We will not require a consolidated financial statement for the group. If a company A has a associate company B, then the company A will prepare its own financial statements separately, B will prepare its own financial statements. A need not prepare a consolidated financial statements incorporating the financial statement of its own and that of B. So here the guidance will be provided under IS 28. So subsidiary versus associate versus joint arrangement. Let's look at a comparison of subsidiary versus associate versus joint arrangements. So recognition criteria is for subsidiary is control, for associate it is significant influence, for joint arrangements it is joint control. That means control along with another entity. So in case of subsidiary, normally the control is exercised by ownership of more than 50% of the voting shares. For associate, significant influence is normally achieved through ownership of 20 to 50% of the shares of the associate company. In case of joint arrangements or joint control, equal with another entities. Equal shareholding with another entities. In case of subsidiary, there is a requirement of consolidated financial statement. For associate, no consolidated financial statement is needed, and for joint arrangements also no consolidation is required. Accounting, for subsidiary it will be the acquisition method, full consideration. For associates it will be equity method, and for joint arrangements it will be again equity method. So we will be discussing the equity method now because we have already talked about the acquisition method, that is full consolidation in the case of a group involving a parent and subsidiaries. Now objectives of the IS 28 or the standard which is called in Accounting Standard 28. First of all, we have to recognize a significant influence for establishing an associate relationship. So we need to recognize a significant influence when a significant influence exists for establishing an associate relationship with another entity, to prescribe the accounting for associates, investment in associates, and to set the requirements for the application of equity method of accounting for joint venture and associates. Significant influence is the power. What is significant influence? Now we are coming to the definition of significant influence. It is the power to participate in the financial and operating policy decisions of the investor. If the investor company has the powers to participate in the financial and also operating policy decisions of the investee, not control, but it has the powers to participate in the financial and operating policy decision of the investee, maybe through nominating some directors or having some directors in the board, things like that. Significant influence should not be confused with control. Control and significant influence are different. So significant influence is not control. Control means it's a subsidiary. Significant influence is not even joint control. Significant influence is not even joint control. When you have control over another company along with another entity, another company A with company B has joint control over another entity, then it's a control. But significant influence is neither joint control nor it is control. It is the power to participate in the financial and operating policy decisions of the investee. Normally, significant influence could be established by either by ownership of more than 20% equity or by establishing the substance of transaction between the entities with any or more of the indicators that demonstrates power to participate, as we will see in the next slide. So either ownership of 20%, more than 20% equity but less than 50% equity of the investee company, or by establishing the substance of transaction between the entities with any one or more indicators which demonstrates power to participate, as we will see in the next slide. Significant influence is usually evidenced. Where it is evidenced? In one or more of the following ways. One is the representation on the board of directors. If a company A has owning say 30% or 40% of shares of company B, they can have some representation in the board of directors of company B. So representation on the board of directors. They can also participate in policy making through the representation in the board of directors. The company A can participate in the policy making, including decisions about dividends. They cannot control it, but they can participate in policy making, including decisions about dividends. A close relation, sometimes significant influence can be also evidenced through a close relationship involving transactions between investor and investee. Sometimes significant influence can be established through a close relationship involving transactions between investor and investee, which could be also through interchange of managerial personnel. That means managerial personnel of A can be transferred to the company B and can work there, or vice versa. Or provision of essential technical information to be provided by A to B. So if there is provision of essential technical information that A will supply to B, that can also evidence a significant influence. So significant influence can be evidenced in different ways. Okay. Equity ownership of more than 20% is not the only decisive factor. So there can be other indicators through which significant influence can be evidenced. Example, let's see the case study. X owns 60% of the voting rights of Y. Company X owns 60% of the voting rights of Y. Z owns 19% of the voting rights of Y, and the remainder are dispersed among the public. So the voting rights of Y, 60% is held by X. Z is holding 19% of the voting rights, so remaining 21% is dispersed among the public. Z is also the sole supplier of raw materials to Y. Z is the sole supplier of raw materials to Y and has a contract to supply certain expertise regarding the maintenance of Y's equipment. Is there significant influence by Z on Y? Now remember, Z is only owning 19% of the voting rights of Y. So that way, it is not 20% or more. So that way we cannot say there is significant influence. But Z may be able to exercise significant influence over Y because it is the sole supplier of raw materials to Y and also provides expertise in the form of maintenance of Y's equipment. So that way, although it owns 19% of the voting rights, it can exercise significant influence over Y because it is the sole supplier of raw materials to Y and also provides expertise in the form of maintenance of Y's equipment. So we are looking at basically a situation where a close relationship involving transactions between investor and investee is there and provision of essential technical information is there. So there are other indicators of significant influence. Ownership of 20% to 50% of shares, voting shares, is not the only indicator of significant influence. Of course, when a company A owns 20% to 50% shares of another company, it has a significant influence, but it is not the lone indicator for significant influence. There can be other indicators which can point out to a significant influence of one company over the other. That is the example we have seen here where Z owns 19% of the voting rights of Y, but because it is the sole supplier of raw materials to Y and provides expertise in the form of maintenance of Y's equipment, Z has a significant influence over Y, so Y can be considered an associate of Z. Y of course is a subsidiary of X, no doubt about this, because X owns 60% of the voting rights of Y. So the same company Y could be a subsidiary of X and at the same time could be associate of another company which is Z. Now we are talking about the equity method, which applies to both to associates and joint ventures, investment in associates and joint ventures. So IAS 28 prescribes that both associate and joint ventures are accounted for using the equity method. Although IFRS 11 recognizes a joint arrangement is a joint venture and requires that such joint venture be accounted for using equity method which is prescribed in IAS 28. Remember, IFRS 11 recognizes when a joint arrangement should be considered as a joint venture and requires that such joint venture should be accounted for using equity method which is prescribed in IAS 28. So same IAS 28 will apply to joint venture as well as to investment in associates. So what is equity method? We'll just briefly describe the equity method. Equity method is a method of accounting by which an investment is initially recognized. Initial recognition will be done at cost. So the investment will be always, initial recognition will be done at cost, and subsequent measurements of that investment will be made by adjustment to reflect the post-acquisition change in the investor's share of the net assets of the investee. The profit or loss attributable to the investment in the associate is included in the investor's income statement. So the profit or loss which is attributable to the investment in the form of dividends, etc., will be included in the investor's income statement. So initial recognition is the cost of investments, that is at cost. Then we have to add share of the post-acquisition profit. So to arrive at the subsequent measurement of that investment. Two-way impact. On the asset side, we will have the cost of investment associate will increase by the share of the post-acquisition profit. So there will be two-way impact of this. When we are remeasuring a subsequent measurement of the following the equity method, when we are making subsequent measurement of the investment in an associate or joint venture, the initial measurement was at cost. The subsequent measurement on the reporting date will be cost plus cost of investment plus share of the post-acquisition profit. So on the asset side, the cost of investment in associate will increase by share of the post-acquisition profit. On the liability side, the retained earning account will increase by the share of the post-acquisition profit. So that way the balance sheet will tally. Because on the investment side, we are increasing, supposing the investment at cost was 1 million. And the share of post-acquisition profit is, let's say, 100,000. So as on the reporting date, the investment will be shown at 1 million plus 100,000, that means 1.1 million. That will be on the asset side. So the asset side will increase by 100,000. On the liabilities, the retained earnings account of the investing company will also be raised by the share of the post-acquisition profit. So the retained earnings also will increase by 100,000. So both sides of the balance sheet will tally. So the asset side will be tallying with the balance sheet. Goodwill in an associate. If there is a goodwill in an associate, it is not separately recognized. It is included in the investment. So there is no separate recognition of the goodwill in the case of investment in associates. It will be part of the investment. The entire carrying amount will be tested for impairment. So if it is an investment associate instead of in a subsidiary, then goodwill will not be separately recognized. If it is an investment in a subsidiary, goodwill has to be separately recognized. But if it is an investment in a associate, the goodwill will be part of the investment. It will be included in the investment. Only thing, the entire carrying amount of the investment will be tested for impairment every year. Let's look at an case study. The company A acquires 25% of the voting shares of B on January 1, 20x5. Company A acquires 25% of the voting shares of B on January 1st, 20x5. The purchase consideration paid was 10 million and A has significant influence over B. So it's an associate relationship. So B is an associate of A. The retained earnings of B were 15 million at the date of acquisition. The retained earnings of B, the associate company, were 15 million at the date of acquisition or investment. And the A group has several other subsidiaries. The retained earnings of B as at 31st December 2005 were 21 million. Now calculate the carrying value of the investment in B in the group financial statement as at December 31st, 2005. So A is preparing a group financial statement. A has several other subsidiaries, so it is preparing a consolidated group financial statement. How the investment in B will be reflected in that group financial statement. Now cost of investment in B was 10 million on the date of acquisition of the 25% of the voting shares. So cost of investment. Then we will add the share of post-acquisition reserves. 25% is the share of the voting shares. 25% voting shares are acquired by A. So 25% of the increase in retained earnings. In retained earnings are 15 million on the date of acquisition. It became 21 million on the reporting date, that is 31st December 2005. So the difference 21 minus 15 million is the increase in the Retained earnings and share of post-acquisition results will be 25% of that, that is 1.5 million. So the investment will be shown on the date of reporting in the consolidated financial statement. Investment in B will be shown, the figure will be remeasured at 11.5 million. The share of the post-acquisition results also will be credited to the retained earnings of the group. That is, 1.5 million will also be added to the retained earnings of the group. Goodwill, as I told you, in associate is never separately recognized, it is included in the investment. The entire carrying amount, that is 11.5 million, should be tested for impairment. In the consolidated income statement, income from associates for the year is reported after profit from operations just before profit from tax. So if the consolidated income statement, income from investment in the associates for the year will be reported after profit from operations, but just before the profit before tax, because it is tax has to be paid on that income also. So impairing testing for investment, as I told you, when an investment is made in an associate, the goodwill is not separately measured or recognized. So goodwill becomes a part of that investment. So the entire carrying amount of the investment is tested for impairment under IAS 36 by comparing the recoverable amount with the carrying amount. So we know impairment, we have already discussed under IAS 36. So testing for impairment will be done under IAS 36 by comparing the recoverable amount of that investment with the carrying amount. Impairment indicator in IAS 39 will apply also to investment in associates. Since the goodwill is included in the carrying amount of the investment in associate and is not separately recognized, it cannot be tested for impairment separately by applying IAS 36. Hence, the entire carrying amount of the investment will be tested for impairment under IAS 36 by comparing the recoverable amount of the investment with the carrying amount, and if there is an impairment, impairment entries will be passed. So, this session basically we are ending the consolidation of financial statements. So here we talked about goodwill, which is the excess of the amount transferred plus the amount of non-controlling interest minus the fair value of the net assets of the subsidiary. We have talked about the comparative position between subsidiary, associate and joint ventures. They are mapped on different levels. There are several ways to check for significant influence, not only the ownership of 20 to 50% shares, but even close business relationship or say providing of essential technical support, etc. This can also be indicators of significant influence. The entire carrying amount of the investment will be tested for impairment under IAS 36 because goodwill is not separately recognized in the case of investment in associates. So the entire carrying amount of the investment will be tested for impairment under IAS 36 by comparing the recoverable amount of the investment with the carrying amount, and if there is a shortfall, there is an impairment, and impairment entries have to be passed. So this completes our discussion on consolidated financial statements, etc. So if you have any questions, you can ask at this point of time, because next thing we will be talking about is basically ratio analysis. We are finished with accounting discussion on various accounting standards, but basically we will be now talking about how these financial statements are actually used. So we will be talking about the utilities or usefulness of the financial statements, how they are actually used, because we have so far discussed about preparation and presentation of financial statements and the various standards that apply. Okay, but when the financial statements are prepared and presented for use of the investors, how the investors or various other users are going to use these financial statements. So that is what we are going to be discussing over the next two lessons, which will start today and will be ending on Friday. So we will talk about the meaning and significance of financial statement analysis. So what we are going to do here, we are going to talk about financial statement analysis. Remember, this is not financial analysis. We are not doing financial analysis. What we are doing is analysis of the financial statements. So that is what we are going to talk about here. So it's about the meaning and significance of financial statement analysis. Understand the different techniques of financial statement analysis. What are the various techniques used for analyzing the financial statements? The key financial ratios which are used in evaluating the financial statements, and understand and interpret the outcomes. So this session will purely cover financial statement analysis, and it should not be considered as financial analysis. Financial analysis is a much broader subject. The difference between financial analysis and financial statement analysis I will try to bring up. Financial analysis is a higher and broader term used to evaluate a business or any other broader economic parameter like industry, and used basically in investment banking. So financial analysis application in investment banking, which is a much higher and broader term used to evaluate a business or any other broader economic parameters like industry. So you want a financial analysis of a steel industry, a financial analysis of the cement industry or pharmaceutical industry. And these are basically used in investment banking, equity analysis, etc. Whereas financial statement analysis is only a subset of financial analysis, and is restricted to evaluation of financial statement by its user. So financial statement analysis is only a subset of the financial analysis. It is basically restricted to evaluation of financial statements of an entity by the users of the financial statements. So the scope of the financial statement analysis is much narrower compared to that of the financial analysis. So we will try to cover both analysis techniques and interpretation of the results which arise from use of those techniques. It is important to understand interpretation can never be homogeneous, and it differs from users, industry perspective, etc. So financial statement analysis is a collective name for the tools and techniques that are designed and applied to provide relevant information to the decision maker, that is various users. So basically collective name for the tools and techniques which are used, designed and applied to provide relevant information to the decision maker, that is various users. It is an essential tool used in financial analysis. So financial statement analysis is an essential tool of financial analysis, so it's a subset of the financial analysis. It interprets the respective financial statements and reports, unravel the strength, performance and financial health of the business. So the purpose of the financial statement analysis is to interpret the financial statements and reports to reveal, to tell us what are the strength, performance and financial health of a business. Analysis techniques and its interpretation objectives are dependent on the users. What technique will be used by a particular analyst, how they will interpret the various results, this will be dependent on the users. Okay. So different analysis techniques will be used by different types of users. So if you look at the analysis and interpretation objective based on users, the diagram here represents I think it is not very clear. We need to zoom on with this chart here. Okay. So analysis and interpretation, basically it is based on users. So users could be management. The management of the company wants to analyze the financial statement. Bankers or the lenders, there will be another group of users who would like to analyze the financial statement and interpret the various numbers that come out, and investors. So management, the focus will be on capital adequacy, cost management, budgeting, profitability analysis, investment decisions. So for the management, the objectives are different. Capital adequacy of the business, cost management aspect, budgeting aspect, profitability analysis, investment decisions. For the bankers or the lenders, the objectives could be different. Liquidity, they would like to know the liquidity position of the business, debt servicing ability of the business. They want to assess the creditworthiness of the business, and based on that, lending decisions will be made. So because the lending decision by a lender will depend on what the liquidity position of the business, debt servicing ability of the business, and creditworthiness of the business, so they will be interested in, their focus will be on these areas. For investors who are going to invest or already invested in the company, they are interested on return on investment, because buy and hold decision will depend on whether they are getting adequate return on the investment or not. If they find that the company is generating good return on the investment, they will try to buy or hold the shares. If they find that the company is not able to generate adequate return on the investment, they can even sell their shares. So various users have got various kinds of objectives and focus. Management is one group of users. Lenders or creditors or bankers are another group of users. They are more interested in safety of the funds they are lending. Investors is another group of users. They are interested more in the return they are getting on the investment. So the interpretation objective will be, and analysis methods will depend based on the users. The various analysis techniques which are used are ratio and comparative analysis with previous years and other companies, comparison with other companies in the same industry. So ratio analysis or comparative analysis can be done considering the previous year by comparing the previous year's performance with the current year's performance. Comparing the previous year's performance with the current year's performance. It can be also done by comparing the performance of one company with other companies in the same industry. So these are the analysis and interpretation objectives which are based on users. So different users have different requirements and objectives you have to understand. Here's the touch upon the dimension required by them. For example, the banker or lender to a company is keen to know whether a particular loan could be granted. If yes, then what will be the limit? How much loan can be granted and time duration for how long the loan can be granted, how much loan plus interest repayment company can bear in the coming years, etc. So they would basically focus on knowing the company's creditworthiness, debt servicing strength and liquidity position from the financial statement analysis. So they will try to basically understand these aspects of the company's business. Again, by taking the same example, it is pertinent to note that the same user will evaluate all these parameters over a number of years. They will not look at only 1 year's financial statements. They will look at all the parameters over a number of years to determine the trends, compare with similar industry indicators, and planned values with future years to arrive at conclusion. The standalone values for the current year for the same company doesn't give us much interpretation. So we have to basically compare it with the previous years, the parameters for the previous years to know the trend. Okay. The standalone value for 1 year will not give us much to interpret. Financial statement analysis also consists of comparison trends for the same company over a period of time and comparisons of different companies either in the same industry or in different industries. So analysis techniques which we will be using or we will be talking of is ratio analysis and second is comparative analysis. Under ratio analysis we will be talking of short-term or liquidity ratios, long-term or solvency ratios, then capital structure or leverage ratios, various types of efficiency ratios and profitability ratios. So these are the 5 broad groups we are going to discuss. Under comparative analysis we will be discussing about vertical, horizontal, trend analysis, interfirm comparison, common size financial statement analysis and percentage change method. So basically we will be covering some of them with greater details. So ratio basically is a technique of establishing numerical relationship between different components of financial statement. So ratio basically means establishing a numerical relationship between different components of financial statements. Whereas comparatives is the relative study of either the ratios derived or the actual values of different components of financial statements, like say a comparative study of current assets as a total or as percentage of the asset side over number of years, or current ratio comparison over number of years or with the industry. So both kinds of ratio analysis and comparative analysis will be discussing. Now the significance of ratio analysis, what is the significance? It can give us inter-firm comparison within the industry. Ratio analysis can allow us to make comparison of one company with another company within the same industry. It can help us to benchmark against the best practices. It can evaluate the viability of a product line or a business segment. It can be used to understand trend analysis of the same enterprise over a number of years. Or basically the ratio analysis is very popular because it is even easy to understand for the non-financial and account decision makers, giving a high-level view. So the people in the top management, they may not be necessarily coming with finance and accounting background. So those who do not have finance and accounting background but still at the decision-making level, it is easy to understand for them also. It is easy to understand the ratio analysis is for them without even having much background in finance and accounts. One can understand the meaning of the ratios and can interpret the ratios, and that can help them to making decisions by taking a higher level view. So we'll talk about mainly 5 types of ratios. First one is the short-term financial position or liquidity ratios. The other one will be solvency ratios, then capital structure or leverage ratios, efficiency ratios, and profitability ratios. These are the 5 broad groups of ratios we will talk about. So liquidity ratio, short-term, basically we are talking about the first one, which is short-term financial position or liquidity ratios. So liquidity ratio, basically these ratios are used to test the short-term solvency or liquidity position of a business. Short-term solvency or liquidity position of a business is the business is having enough of liquid assets to pay its maturing obligations. So this signifies whether the short-term liabilities, because the short-term liabilities will get converted into cash or cash equivalents. Whether adequate short-term liabilities are there to pay out all the short-terms. Basically, short-term liabilities have to be met in a shorter period of time. So whether short-term liabilities can all be made out of the short-term assets which will eventually get converted into cash and cash equivalents. So short-term assets are those assets which are going to be converted into cash or cash equivalents over a short period of time. So whether that short-term assets available with the company, the value of the short-term assets available with the company which will eventually be converted into cash or cash equivalents, is it adequate to take care of the short-term liabilities which have to be made over a short period of time? So whether the company has adequate liquidity, that means whether short-term assets are adequate to take care of the short-term liabilities. Because if the company doesn't have enough short-term assets to take care of short-term liabilities, then there may be a position where the company will default on its short-term liabilities. So that position can create problems for the company. So we are basically interested in knowing whether there is adequacy of short-term assets to take care of short-term liabilities. Also, they are used to check if an adequate working capital is available to carry out routine business activities and how efficiently that working capital is getting managed. So the liquidity ratio also tells us whether adequate working capital is available with the company to carry out its routine business activity and how efficiently the company is managing those working capital. 2 key liquid ratios we will talk about. One is the current ratio, the other is quick ratio. Now liquid ratio specifically considers the short-term solvency only. It doesn't take into account the long-term solvency. So it specifically considers the short-term solvency only, That is, it is related to meeting short-term liabilities from short-term assets and ensure optimum balance, ideal ratio, as even if current assets are in excess over the ideal ratio, it means business funds are lying underutilized in short-term assets. If the company is carrying excess of short-term assets more than what is required, then this working capital is, it is the working capital, that working capital is remaining unutilized or underutilized, which will eventually affect the profitability or the return on investment, or return on investment, or return on capital employed. So, there is a, we look at optimum level basically, whether short-term assets are adequate, to take care of all short-term liabilities. But if we find that short-term assets are much more than the short-term liabilities, much more than what is required to settle the short-term obligation, then the company may be carrying unutilized short-term assets. So it could be, as a result, the company's profitability may get affected. So current ratio, first we will define what is current ratio. It is the most widely used of all analytical devices based on the balance sheet. Current ratio is the most widely used of all analytical devices based on balance sheet. It establishes a relationship between total current assets and current liabilities. So current ratio is nothing but current assets by current liabilities. We all know the definition of current assets. Current assets are those assets which are going to be converted into cash or cash equivalents within 12 months of the balance sheet dates. Similarly, current liabilities are those short-term liabilities that are required to be settled within 12 months. So current assets are those short-term assets that are expected to be realized in next 12 months from the balance sheet date. Current liability are those short-term liabilities which are due to be settled or paid off in 12 months from the balance sheet date. So the ratio of the current assets, numerator is current assets divided by current liabilities. That ratio is called current ratio. It basically establishes a relation between total current assets and current liabilities. Now if the ratio is less than 1, what does it mean? Means current assets are less than the current liabilities, which means the company doesn't have enough short-term assets to take care of its short-term liabilities. The company is facing a liquidity crunch or a liquidity crisis. If the current assets are too high compared to the current liabilities, that means company is holding a lot of short-term assets which are not really required for the purpose of paying off the short-term liabilities. So it may be carrying excess short-term assets, and these assets may not be generating any return. So the company's profitability may be compromised because of that. Ideal ratio for current ratio, ideal level is considered as 2:1, but it can vary from industry to industry. Although we say ideal ratio is 2:1, that means current assets are sufficient to cover for twice the amount of the company's short-term liabilities. So ideal ratio is 2:1. A high ratio indicates under trading or overcapitalization. A low ratio indicates over trading and undercapitalization. So too high a ratio is not good. It is under trading or overcapitalization. A company is carrying excess working capital. Low ratio indicates over trading and undercapitalization. That means company doesn't have adequate working capital to run its routine operations. Okay. So ideal ratio is normally considered as 2:1, but although it can vary from industry to industry, because there will be some industries where the ideal ratio could be much less than 2:1. Quick ratio or acid test ratio, that is something similar to the current ratio, but here it establishes a relationship between the liquid assets and liquid liabilities. It is basically a refinement to current ratio and a second testing device for a working capital. So quick ratio is basically quick assets by current liabilities. So quick assets, what do you mean by quick assets? This means assets which are more liquid in nature. So we don't include every current asset in the definition of quick assets. So for a business, quick assets basically means current assets minus inventory, minus prepaid expenses, minus advances. Because Inventories or advances to suppliers or tax authorities and prepayments may be excluded from the calculation as they do not result in inflows of cash resources in the future that may be used to settle liabilities. Inventories have to be converted into finished goods and then it has to be sold and then only cash will be available. So inventories, advances to suppliers or tax authorities, prepayments of expenses, although they are current assets, this should be excluded from the calculation as they do not result in inflow of cash resources in the future, which may be used to settle liabilities. So this kind of assets, inventories, prepayments or advances, this kind of assets are not realizable into cash quickly, so they are excluded from the current assets figure. So we get quick assets, and quick assets is divided by current liabilities to arrive at the quick ratio. So quick assets basically comprise of cash, debtors, bill receivable, marketable securities and cash at bank. So these together comprise the quick ratio. So the ideal ratio is considered as 1:1. That means the assets which can be quickly realized into cash are adequate to take care of the maturing short-term liabilities for taking care of the payments of those. Normally business should aim to maintain a quick ratio that provides sufficient leverage against liquidity risk given the level of predictability and volatility in a specific business sector among other considerations. So although the ideal ratio is quick ratio is 1:1, business should aim to maintain a quick ratio which provides sufficient leverage against liquidity risk given the level of predictability and volatility in a specific business sector among other considerations. The more uncertain the business environment is, the more likely that companies would maintain higher quick ratios than 1:1. Contrariwise, where cash flows are stable and predictable, companies would seek to keep quick ratio at relatively lower levels. Now we come to what we call solvency ratios. The liquidity ratios are basically short-term solvency ratios. Now we are talking of solvency ratios, test of solvency. It signifies the ability of an organization to repay the loan and interest. Whether the organization will be able to repay the loan and interest. If assets are more than the liabilities, it is known as a solvent entity. If the company's assets are more than the external liabilities, outside liabilities, it is a solvent entity. The company will be able to pay off the external provider of funds. Okay. It reflects whether an enterprise is capable of meeting long-term obligations. Sorry, I think we have to stop the session here because there is hardly any participation here. So there is no point in continuing the session today. So we'll try to complete this session along with the next lesson on the next day. So we'll close the session today because of there is not enough participation. Only one participant is still available. So let's close the session.